From the following information of Messrs. SUN Ltd, prepare a balance sheet for the year ended 31st March 2022. The current ratio is 2.5:1. Liquid ratio is 1.5:1. The bank overdraft is given to us as 40,000. Working capital 1,50,000. Reserves and surplus 80. We've been given fixed assets to proprietors fund at 0.75:1, and the ratio of the only current assets, debtors, stock, debtors and cash balance in the ratio 11:5:4. All of this helps us think of what is the balance sheet going to be. Alright, so first of all, keep in mind current ratio is equal to current assets upon current liabilities. Which we've been given as 2.5:1. Okay, and remember, if they are saying 2.5:1, you can literally rewrite this as 2.5 upon 1. And anything upon 1 is just written as the number itself. So I'm just writing 2.5. And I'm going to follow that same logic for the liquid ratio. But remember, the liquid ratio, also called the quick ratio, also called the acid test ratio, is equal to quick assets upon quick liabilities. Okay, and we've been given that value as 1.5:1 or just 1.5. We now have the bank overdraft, which is something that we can directly put into the balance sheet. So I'm going to start building the balance sheet on this side. Okay, so let's see, maybe we can have all of this space for the work that we're doing here. Right? Please use scales when you're working. Okay, and I'm now going to start with the balance sheet on this side. Okay, so a horizontal balance sheet should do. Okay, if you remember your format for a horizontal balance sheet, it's going to be liabilities on the left hand side and assets on the right hand side. Alright, so we have liabilities and amount, of course, in terms of rupees, assets and amount in terms of rupees. And when you're doing a company balance sheet, you have certain usual suspects. We have to have equity, share, capital. Okay, we normally have reserves and surplus, and we have a whole bunch of current liabilities, long-term liabilities, and we need to see from the question. For now, I'm just going to go all the way down here and write bank overdraft, and the amount of bank overdraft given to us in the question is 40,000. Okay, so I'm just going to write down 40,000. Now, going forward, we've been given the working capital as 1,50,000. Okay, so I'm going to scroll down slightly and I'm going to write down the formula for working capital. Working capital is equal to current assets minus current liabilities which is equal to 1,50,000. Now, Reserves and surplus, they've given us directly 80,000. So I'm going to go back to the balance sheet corresponding to reserves and surplus. Alright, so this is our balance sheet and I'm going to write 80,000. And yes, you should be perfect in what you do. So the name of the company is Messrs SUN Ltd. So I'm also going to do that. Okay, Messrs SUN Ltd. And we have a balance sheet. They've asked us to make the balance sheet for the year ended 31st March 2022. Okay, so balance sheet as at 31st. Okay, and I know my handwriting is horrible, please bear with me. 31st March 2022. Now, going forward, we have accounted for the bank overdraft, working capital, reserves and surplus. Next, we have fixed assets to proprietor's fund. And what's good about this particular ratio is that the name of the ratio is the formula. So fixed assets to proprietor's fund actually means fixed assets to proprietor's fund. Okay, so divided by proprietor's funds. Now, we need to understand that fixed assets are those assets which remain with the business for more than a year, and proprietor's fund is equity share capital plus reserves and surplus. Alright, so this is going to help us calculate perhaps the equity share capital and fixed assets going forward. For now, just remember that it is in the ratio 0.75:1. Now, they've also told us that the current assets include only these items. Okay, so for the sake of completeness, I'm going to do it here first, and then we can at least give the outline in the balance sheet. Current assets is equal to only stock, debtors and cash balance. Okay, and that makes life easy when we are trying to build the balance sheet. I know that fixed assets exist because we have a ratio for fixed assets to proprietor's fund. Okay, fixed assets, and under current assets I know that it is debtors. Okay, and let's follow the same order that we've been given in the question. So stock, debtors and cash. Alright, so I know it is stock, debtors and cash. Now, the other item that we could normally have in these kind of questions is investment or long-term investment and fictitious asset. We have not come across any ratio which discusses investment, and our last adjustment specifically tells us that there is no long-term loan and therefore there is no debentures, there's no bank loan, there's no term loan, and now we are in a position to go ahead and complete our calculation for current assets and current liabilities because we have got enough of data. Alright, notice what we have over here. Okay, I'm going to do it on this side. Notice what we have here and what we have here. We have got two formulae which we can then use to isolate the value of the current assets and current liabilities. Alright, so I'm going to use short forms to make it easier to solve. Alright, so I'm going to scroll down slightly so I can look at both of them. Okay, and I know that CA, okay, so since current assets upon current liabilities is equal to 2.5 and current assets minus current liabilities is equal to 1,50,000, I can say that current assets is equal to 2.5 times current liabilities. Okay, and okay, so maybe we could have just done this, and now I can substitute it in this formula. So I can say that 2.5 current liabilities minus current liabilities is equal to 1,50,000. That means 1.5 current liabilities is equal to 1,50,000, and therefore current liabilities is equal to 1,50,000 upon 1.5. And yeah, for those of you who are a little weak in algebra, 2.5 CL minus, see, if you've just got CL written on its own, it is understood it is 1 CL. So 2.5 minus 1 on the calculator, if you do, you get 1.5. Anyway, 1,50,000 upon 1.5, and I'm going to do this on the calculator, even though the answer should be 1 lakh, but let us be sure. Okay, so we have 1,50,000 divided by 1.5, which gives me a lakh. Alright, so I have 1 lakh as my value for current liabilities. Okay, but now I also want current assets. So if I know that current assets minus current liabilities is 1,50,000, therefore I can say that current, okay, let's do it on the next line. Alright, so current assets minus 1 lakh is equal to 1,50,000. This over here, subtraction goes that side, it becomes addition. Okay, and therefore we have current assets is equal to 1,50,000 plus 1 lakh. Okay, and we have 1,50,000 plus 1 lakh, right? And again, therefore current assets is equal to 2,50,000. Keep in mind, it's not over yet because we need to break up this 2,50,000 among these people. But that becomes easy because we know the ratio, 11:5:4. Okay, so 11:5:4. For now, we have both current assets and current liabilities. Remember, bank overdraft is here. And as far as a formula for quick assets and quick liabilities are concerned, you need to keep in mind that the quick ratio is equal to quick assets upon quick liabilities, and quick assets is actually equal to current assets minus stock. It's also equal to minus prepaid expenses, but we do not have prepaid expenses in this question, so I'm just sticking to stock. Similarly, this is current liabilities minus bank overdraft. Okay, so minus bank overdraft. And why am I getting into this? Because while we have the value for bank overdraft, we do not know what the other current liabilities are, but we can at least call them quick liabilities. Okay, so quick liabilities is equal to current liabilities, which we know is 1 lakh, minus the bank overdraft, which we know is 40,000. Okay, so we get quick liabilities as 60,000, which is something which we can now put in the balance sheet. Okay, so I'm just going to put them on top. Quick liabilities is 60,000. Now, as far as my current assets are concerned, it's become very crowded. Remember, we have got ourselves current assets. We have found current assets to be 2,50,000. Okay, I have this number. So I'm going to go to the balance sheet now, and I know that the total anyhow is going to be 2,50,000. But I need to break up this 2,50,000 in the ratio 11:5:4. Okay, in the ratio 11:5:4. So I'm going to go back here and do that. So how do we break up 11:5:4? We add 11 plus 5 plus 4. Do it on the calculator and you're going to get 20. So we take 2,50,000 and multiply it into 11 by 20 to get stock. Okay, the same 2,50,000 we are going to multiply into 5 by 20 to get debtors, and again into 4 by 20 to get ourselves cash. Now, on the calculator, here we are, 2,50,000 into 11 by 20 gives me 1,37,500, and I have 1,37,500. Alright, next we have 2,50,000 into 5 by 20. Okay, and that gives me 62,500. So I'm going to write over here 62,500. And again, 2,50,000 into 4 by 20, and that gives me 50,000. Alright, now we have most of the numbers in place. Alright, we have almost everything. We have almost everything on the left hand side, liability side, except for equity share capital. Similarly, on the right hand side, we have everything except for fixed assets. Now, we've been given the working capital as 1,50,000. And we need to keep in mind, whenever we are running a business, you are investing money from your own side. The money that's coming from the owners is as good as what we call the proprietor's funds. Proprietor's funds are then used to go and purchase assets. Okay, so normally proprietor's funds plus borrowed funds are utilized to buy fixed assets and current assets. At the same time, we have got current assets. We also have current liabilities, which you can put on the left hand side as plus current liabilities, or on the right hand side as minus current liabilities, and it subtracts from current assets to give you working capital. Okay, so I'm going to use short forms now. Proprietor's funds plus borrowed funds is equal to fixed assets plus current assets minus current liabilities. Okay, and proprietor's funds plus borrowed funds is equal to fixed assets plus working capital, because working capital is current assets minus current liabilities. And in this particular question, since there are no borrowed funds, since there are no loan funds, this number is 0. Therefore, only in this question, proprietor's funds will equal to fixed assets plus working capital. And do we have proprietor's funds given to us directly? No, but we've been told it is in the ratio 0.75:1 with the fixed assets, and that is going to help us a lot. Okay, so let's see. We have an equation where fixed assets to proprietor's funds, fixed assets, FA upon PF is 0.75. FA upon PF is equal to 0.75. Working capital, we have a value. Going back upstairs, working capital is equal to 1,50,000. Okay, so we have proprietor's fund is equal to fixed assets plus 1,50,000. Okay, so we have this as one equation, this as the second equation, and if fixed assets upon proprietor's fund is equal to 0.75, proprietor's fund is division, goes that side becomes multiplication, I can say fixed assets is equal to 0.75 proprietor's funds. And now we can substitute. Okay, so we have 0.75. Okay, on the right hand side, let's see. We have got proprietor's funds is equal to 0.75 proprietor's fund plus 1,50,000. Now 0.75 on this side is addition, goes that side it becomes subtraction. Okay, so we have proprietor's fund minus 0.75 proprietor's fund is equal to 1,50,000. Okay, and I'm just going to continue on this side. Okay, we have 0.25 proprietor's fund is equal to 1,50,000. So proprietor's fund is equal to 1,50,000 upon 0.25, and therefore proprietor's fund is equal to, and we have 1,50,000 upon 0.25. So that's 6 lakhs. Now, proprietor's fund is 6 lakhs, and we know that the reserves and surplus is equal to, given to us in the question, reserves and surplus is equal to 80,000. Is equal to 80,000. I've already told you before that the proprietor's fund is equal to equity share capital plus reserves and surplus. Okay, so 6 lakhs is equal to equity share capital plus 80,000, and we solve for this and we get equity share capital is equal to 5,20,000. Okay, 80,000 over here is addition, goes that side it becomes subtraction, and therefore we end up with that number. I'll do it once on the calculator for your satisfaction. Okay, and we have 6 lakhs minus 80,000, which gives us 5,20,000. Okay, so I know that equity share capital is 5,20,000, and the only thing I need now is the fixed assets. Alright, and we have a formula over here. Okay, simplistic formula. Fixed assets is equal to 0.75 proprietor's fund. So since, again, I'm just going to do it downstairs over here. Fixed assets I do not know, but I know it is equal to 0.75 into proprietor's fund, which is 6 lakhs, and therefore we take 0.75 into 6 lakhs and we get 4,50,000. Okay, so fixed assets is 4,50,000. Equity share capital 5,20,000. So I'm just going to go and fill them up. Okay, 5,20,000, 4,50,000, and with that we are done with the question. All that's left is the moment of truth. Is it going to tally? Alright, so let's see. We have 5,20,000 plus 80,000 plus 60,000 plus 40,000, which gives us 7 lakhs on the liability side. Right, so 7 lakhs on the liability side, and on the asset side we have 4,50,000 plus 1,37,500 plus 62,500 plus 50,000. Congratulations, 7 lakhs on the asset side. This balance sheet tallies, and with that we are done with this question. This is a slightly longer video. I hope everybody has found this useful. Anybody having doubts, feel free to comment. Please like this video, subscribe to my channel, and share it with your friends. Good day.